Hello, everybody, and welcome to my solution walkthrough for exercise 1513. This is the textbook Intermediate Accounting, 17th edition. Authors are Don Kiso, Jerry Weinget, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett, myself, Bennett Tchaikovsky, and not the authors of the textbook or Wiley. Okay, so let's go ahead and take a look at exercise 1513. The common stock of Alexander Hamilton is currently selling at $120 per share. The directors wish to reduce the share price and increase share volume prior to a new issue. The per share par value is 10, book value is 70 per share. 9 million shares are issued and outstanding. I'm going to say this because I've been doing this now, but when you see a $10 par value, someone's going to get sued. This is Home Depot. They have a 5-cent par value. This is Meta World Peace. No, it's the other Meta company. So hopefully Ron Artest or Meta World Peace will be doing his business and taking it to the Facebook. So here you've got 0.000, it's a fraction of a penny. Why is par value a fraction of a penny? Par value is a fraction of a penny because if you sell a share for less than, if the corporation sells a share for less than par value, they are going to cause the shareholder to have a liability for the difference between the par value and what they paid for it. And you do not want to do that. Trust me. So again, why this textbook uses such a high par value, I've written to the authors about it. I think they're going to change it for the 19th edition. But again, it's something that's just shouldn't be happening. So right over here, so prepare the necessary journal entries assuming the following. The board votes for a 2-for-1 stock split. Okay, so when we're dealing with shares, and the best thing to look at is we look at an existing publicly traded company. You have shares authorized, issued, and outstanding. So my authorized shares, this is where basically in my articles of incorporation, this is where I'll come out and say the company's authorized to issue 1 million shares of stock. It might be 10 billion shares of stock. Whatever it might be, just remember I can always start small and end up going big, right? And most corporations are going to be doing business in the state of Delaware. So it's just something just to kind of keep in the back of your mind. But again, once you incorporate a company, you can always change the number of shares that are authorized. So it's basically you have to go ahead and get it done by corporate resolution. There's essentially an announcement when it's going, basically when something happens like this. The other part is, why do companies do a stock split? A company will go through and do a stock split mainly because it's essentially a way of, and you'll see companies do this all the time. For example, Tesla. If your stock gets up to a price which becomes formidable, meaning that if my shares are trading at $1,000 a share, it's going to be really hard for investors to go through and to buy those stocks, although now you can buy fractional shares. But that's when companies will do stock splits. And when you look at companies like Apple that did one in 2013, and then I think they did one, I want to say in 2020 or 2021, it essentially helps more people being able to buy the stock. So right over here, we don't know what the authorized shares are, but it tells us that 9 million shares are issued and outstanding. Okay, so those are issued and outstanding shares. And the other thing just to kind of keep in mind too is that the authorized always has to be greater than the issued and outstanding. So I'm just going to make an assumption here. We're just going to go ahead and say that the company had 100 million shares authorized. Okay. Now, prepare the necessary journal entries, assuming the following. The board votes for a 2-for-1 stock split. When I do a stock split, either forward or reverse, I'm not going to really, there's really nothing for me to do for a journal entry. And what ends up happening is I essentially take away the 1 share from the shareholder, and I'm going to go ahead and replace it with 2 shares. So what happens is pre-split, and then we have post-split. Okay, so this is what ends up happening when I do for letter A. And again, I'm making this number up. This is made up, right? But this is effectively what's happening. There's no journal entry. But from a practical standpoint, if pre-split, I'm a shareholder, say I own 100 shares at, I don't know, we'll say at $20. So we'll say at 100 shares at $120 per share. Okay, so price per share, pre-split, price per share. So my total value is going to be 100 shares times 120 bucks, or basically $12,000. Now, post-split, what's going to happen? It's a 2-for-1 forward split. Okay, so 2-for-1, basically a 2-for-1 stock split. So post-split, if I'm the sample shareholder, I'm now going to have 200 shares. But what's going to happen in the marketplace is that the marketplace is essentially going to fractionally adjust the stock. So essentially over here, so my post-split price per share is not going to be 120, it's going to be 60. So my total value has not changed, but if I'm a shareholder, I now have the upside of my stock, and also the company, my stock can actually grow more because, again, it's a psychological factor in terms of stocks being too highly priced. If you look at Berkshire Hathaway, they have never split their stock. Their stock trades to buy 1 share of Class A, it's $481,000. That's because they've never split their shares. So they have a $5 per share par value. If it's Berkshire Hathaway, I'm cool with it, but this other stuff at 10 bucks per share, that's really doesn't make a lot of sense. So the directors wish to reduce the share price and increase share volume prior to a new issue. This book price per share is par value is 10, book value is 70, and 9 million shares are outstanding. So we don't really, when it comes to the stock split, we don't really care about the book value per share. That doesn't really come into play on this one over here. Okay. Now, when it comes to a stock dividend, okay, and this I do have a problem with. What a stock dividend is effectively going to go through and do is that using this par value, you can hear my frustration with this already. So if you have over here 100% stock dividend, what you're going to do is you're going to say, so my issued, or I should just do this on the outstanding shares. So my outstanding shares are 9 million. If I'm giving a stock dividend of 100%, I'm effectively I'm going to be putting out, basically, it's the outstanding shares times 100%. So in this case, so my new amount of outstanding shares is going to be 18 million. Now, when I do a stock dividend, this is going to be essentially be treated. When I do a stock dividend that's more than 25%, what I'm going to do is I'm going to go ahead and put in common. I'm going to go ahead and debit stock dividend or retained earnings. And then I'm going to go common stock dividend distributable. Okay, so right over here, the way I'm going to do this is, and then once I distribute it, I'm going to be crediting common stock at par. So this is going to be 9 million times the par value per share, or $90 million. And I have a huge problem with this, and I'll explain why in a second. Okay, and then this would actually be coming out, right? So if you look at this is if you have a stock dividend. When I have a large stock dividend that's greater than 25%, I'm going to show the issuance at par. The problem with this question is that the par value is so high, right? I got this 90 million by taking 9 million stock dividend times $10 par value per share. Okay, so that's how this came up. So now, in my opinion, this is going to get closed out to retain earnings. We have now artificially, well, it's artificial anyways, but we have artificially deflated retained earnings. And you're pretty much over here getting to the same, basically to the same result. Now, a more realistic one over here would be, well, like, let's assume part B, but the par value of the stock is we'll say it's 0.001 or 0.0001. Okay, so if this in fact was the case, I would be debiting stock dividend, retain earnings, crediting common stock dividend distributable, common stock dividend distributable crediting common stock at par. So what this would be then, this would be 9 million times 0.0001 or $900, which seems to be a little bit more reasonable. I don't know why you would choose to do a stock dividend in this situation instead of just doing a stock split. The one issue that's over here is that if you don't have enough authorized shares, you could have a problem, because when you're doing a stock dividend, you're just increasing the amount of issued shares, whereas if you have a forward split, you're essentially going to be going through and doubling these amounts, right? So this down here is almost kind of de minimis and almost kind of immaterial. The other thing I'm going to say is that if I'm a regulator, if I'm on the NASDAQ or the NYSE, and I see, like, look, this is publicly announced, we're doing a 2-for-1 split, this is what's happening, okay? That makes total sense. This, right, you're not adjusting the value, the market value of the shares. I mean, again, you might be, I've never really kind of encountered this with publicly traded companies. I've never seen a stock dividend of that magnitude, because it's almost like a dividend that's being hidden in disguise, or it's almost like a split hidden in disguise. And this could possibly cause market disruption. If I were a NASDAQ regulator, I'd be saying, wait a second, you're increasing your float by 100%. And therefore, like, what's going on here, right? The other part, and that's going to impact the share price, because up here, when you do a 2-for-1 split, reverse, or whatever might have you, you're essentially giving warning to the market in terms of like what's happening. Now, if I looked at a company like Home Depot, would Home Depot ever do a stock dividend? The answer would probably be no. Why? Because I don't believe that they would be paying a stock dividend to themselves on the shares that they actually own. That's why I think if they were going to do anything, they would be doing a stock, basically a forward or a reverse split, like a 2-for-1 forward split. So when you look at the stock dividend, it's the way the stock dividends work. It's like you're getting something for nothing. It's like, oh, I'm getting more shares of stock. But again, I've seen it before, but it's pretty rare that companies will actually go through and use it. You're really better off doing a forward split. Reverse splits are like a death spiral, so you want to avoid reverse splits at all cost. Okay, and what is a reverse split? Well, instead of, if I did a 1-for-2 reverse split, instead of having 9 million shares issued and outstanding, if it was 1 for 2, I would just take this and divide it by 2. And then that would effectively, your pre-split would be 100, your post-split would now be at 50, and your post-split price per share should technically be at 240, but when the shorts get in there, you're going to be done for the day. Okay, so briefly discuss the accounting and securities market differences between these two methods of increasing the number of shares outstanding. Okay, so again, the way that they're phrasing it, I kind of disagree with their answer. I don't agree that. I think if I was a regulator on NASDAQ or the NYSE, I would really question letter B, because that looks almost like there's some sort of manipulation that's going on. And the par value, what they're look, their book entry of this is correct, but wow, that looks like an artificial way of going through and deflating or manipulating retained earnings. That's what I would say. And I just don't think it's a wise thing to do. So again, and over here, the other part of this is that the par value, when you do a split, is going to be in halved. It's going to basically be halved, whereas the par value under the stock dividend remains the same and your authorized shares aren't changing. The other part of it too is you want to have a healthy amount of authorized shares, because if you have share obligations to deliver either to employees or the like, doing a stock dividend just again is not a very good idea. So with that all being said, I want to thanks to Wiley for, even though I disagree with Wiley sometimes, or with the authors of the textbook, they do, I think, kind of inherently agree with me. I'm taking it from the public side. This is the one major disagreement I have with the authors of the textbook, but I think they've kind of recognized that, and hopefully they're going to be fixing it on a future edition. So don't forget to like and subscribe. If you're looking for other solutions, please feel free to ask for them in the comments. And I look forward to seeing you on the next video. Have a great day.